If you are being sold a whole life, variable life, universal life, indexed universal life, any of these permanent life insurance policies, you are just don't, okay? Don't do it. Because these things, although they are sold expertly, and there's lots of reasons supposedly to buy them, and they're very popular, they are a subpar strategy at best. When you're getting ready for retirement or going into retirement, you want the best strategies, not mid-tier ones. And yes, are there worse things you could do than buy a whole life or a permanent life insurance policy? Sure. But again, we're not trying to go for the least worst. We want to go for the best options. My name is Freeman Lindy. I'm a certified financial planner working with about 67 households, getting them ready for and just inside of retirement, helping them retire successfully and stay successfully retired. And we're bringing the same strategies that we use with our clients to you. And so if you find this helpful, make sure that you subscribe. Otherwise, we're going to jump right into the myths and the lies that you're probably being told about life insurance. And if you're working with someone who's trying to pitch one of these to you, if you already have one and you're a couple years into it, or maybe many years into it, here are some of the things that you're going to want to know about these products. Because doing the best in finance is often just as much about avoiding doing the wrong things as it is about doing the right ones. So today, I'm going to give you 7 reasons why not to buy whole life insurance or permanent life insurance, all those. And the way that we're going to do it today is we're going to look at 7 of the myths around life insurance, 7 of the ways that people pitch them, try to sell them, reasons they will give you to buy one that are in fact not true. So let's dive right into it here. Myth number 1, you should own, not rent your life insurance. So this is a very common one that insurance agents will throw out there that, hey, yes, you can buy term life insurance and it'll cover you for 10 years or 20 years. And if you die during that period, then you'll get the payout, right? But then that goes away and you'll have nothing to show for it, right? You're going to pay a premium for 20 years and it's just gone. And so you don't want to do that. It's kind of like renting, right? If you rent an apartment, you're throwing money away, and at the end of the 20 years of renting, you have nothing to show for it. So instead, we want to buy our life insurance the same way we want to buy a home. And yes, it's more expensive to buy a home than to rent, but in the end, you have an asset. And then that carries on from it, makes it worth it, right? So in the same way, buy permanent life insurance. Yes, it's more expensive, but in the end, if you have an asset, if you've got a whole bunch of cash value, a permanent life insurance policy that will always be there, then it will be worth it. So here's where this breaks down for me, right? Is that, again, if we look at our charts here, you could spend in term life insurance, a small amount over 20 years. So you've spent that amount of money cumulatively over 20 years, let's say, and then that goes away. And you could have your death benefit, which we'll put in purple. We got this mega death benefit way up here. And then as soon as you stop paying on it, that death benefit goes away. And if you die here, you get nothing. And if you die here, you get a ton of money. Awesome, right? Not awesome that you died, but if you're going to, then you might as well get something out of it, right? Alternatively, you could buy instead of rent permanent life insurance, right? And so it's much more expensive. And so we're not even going to use the same apples to apples death benefit because, let's do it actually. To buy the same amount of insurance, now it's not because no one ever does that. So we're going to have way less death benefit. So we'll call it here. So this is term and this is permanent. If you are listening to this on Apple Podcasts later, it should be a vodcast feed, and if it's not, you're on the wrong feed. But you can turn your phone sideways and you can watch what I'm illustrating on the camera here. So you got permanent life insurance, term life insurance, and so you're going to get less death benefit. And they say, hey, we'll get you some more term just to get you the rest of the way. So you end up renting anyway. So you got your permanent, right? Your premium on that is going to be much higher. It's going to accumulate way faster. This isn't necessarily to scale, but part of the problem is that yes, then you will have this death benefit for forever, and you'll put way more into it. But what they never talk about is this difference here, right? The opportunity cost of what you could be doing with that additional money. Because if you took that extra money, right, instead of buying a $50 term policy, you're buying a $250 or $500 a month life insurance policy, what you could be doing with that extra money means that, yes, you might have no more term life insurance anymore, but if you invested that money instead in the market, you would have as much or more in actual investments as you would have had in death benefit over a 20-year period, right? Almost all the time. I've run this a bunch of times. There's only a few 20-year periods in history where you would have ended up with less in investments than if you had bought permanent life insurance, and that's only in the worst possible times. You carried a couple more years out, and you're way ahead. And so it's not just about having something left over or not. It's about what could you do with that money in the meantime. So in the same way, right, you can say, hey, we're going to rent. Don't rent a house. Buy a house. You can rent a house for $1,000, or you can buy a house, the same house, for $5,000 a month. Well, if it's going to cost you $5,000 a month for the same house that you could rent for $1,000, you should probably just rent it instead, because again, you can take that extra $4,000 and invest it somewhere else, and then just buy a reasonable house in cash later. So owning, not renting your insurance is not a good move. So don't do it based on that myth. Okay, myth number 2, permanent life insurance is a great alternative asset class or a non-correlated asset, right? So that's what it's another one that they always pitch out there, right? Is that you want, all right, as we look at, let me grab another color over here. As we look at another, right, everything I do is in timelines because we live over time. So if we got another timeline here, right, they'll say, hey, you've got your investments, they're going up and down all over the place, right? And we want, by the time you get out to retirement, let's say that's here. So your working years, you finally retire, you got all these investments, that's great, but we want something that is going to slowly grow. It's the cash value inside our permanent life insurance, so that when the market's down later, we can spend money out of here and then put it back, and spend money out of here and put it back. And it's going to be a nice flexible policy that we can use. And this, the market's going to go up and down all over the place, but this is going to be a stable, it's not correlated with the market at all. When the market's down 25%, you are still going to get that dividend, that guaranteed income from your cash value life insurance policy. And so it's a great separate asset class to have. And again, it's true that especially in retirement, we teach this and we have videos on this, and I'm sure we'll talk about it again, that in retirement, you want something else that's not just equities. Equities are great for building wealth, but when you're in withdrawal, you don't want to sell down. You want to avoid pulling money out here. Selling here to get money, great. Selling here to get money, not great. Until we need something else to pull from. But rather than dumping a whole bunch of money into something that's going to take forever to grow, the way that we would teach it and the strategy that we follow is say, hey, instead, invest everything in equities. So now if we're not doing this at all and we have all that money going in here instead, you're going to have a lot more, right? So you're going to be way farther ahead in the meantime. Actually, it wouldn't be just this big of a difference. It'd probably be off the charts up here. But then somewhere in here, we can take a chunk. So we lower this, and then that's going to follow it, and we can build this all at once. And so we don't need to be building this slow growth, 4% growth bucket over 25 years. We can build it all at once, 1 to 5 years out from retirement. And that way we get the benefit of the high growth equities all the way up to that point, and then we can just switch it over to cash and bonds and other things in the end to get us where we need to. So don't give up 20, 25 years of high growth equities just so that you can have a non-correlated asset. There are other non-correlated assets we can get at the end, and you're wasting a whole bunch of money by investing in this over the long term. And so permanent life insurance is a horrible, horrible long-term investment, and it can't be a short-term investment because it doesn't accumulate anything in the short term, right? Again, maybe I should quickly review the way that cash value life insurance works, right? Is you have premiums that you pay, so those accumulate over time. Let me just do this on a new one. Yeah. Oh yeah, I guess that works. Nice. Ethan, my producer, is manipulating my camera to make it fit. So you got insurance premiums that you pay, and sometimes they'll stop, sometimes they go forever. That's fine. You got a death benefit that will pay out if you die. That's usually actually flat. So even though you keep paying into it, that remains the same. Sometimes it grows a little bit. And then you've got cash value, which starts at nothing, eventually catches up, surpasses what you've put into it, and then will grow. And you can pull that out at any point in time for any reason, right? But the long term, right? Usually it takes 10 to 20 years to break even on what you've put into it. So you have a 0% net rate of return, not, let alone real rate of return with inflation, right? So if it takes 10 to 20 years to break even in real dollars, it's taking you, 15 to 25 years to break even in inflation adjusted dollars. And then it will grow on to make, maybe 3 to 5%. But we don't want to wait 25 years to get to 3 to 5% growth. We want 8 to 12 that whole time and then build it right at the end. So it's not a great non-correlated asset. Okay, myth number 3, permanent life insurance is a great addition to a portfolio due to its guaranteed returns. Okay, if you look at permanent life insurance, so that's the idea, right? Is they say, hey, even when the market's down 20%, you will still have your guaranteed cash, right? It's guaranteed growth every year. You got it's guaranteed not only not to go down, but it's guaranteed to grow. Plus, it pays dividends on top of it, or whatever else is going on, right? So if you look at, again, everything's in lines, right? If you look at the hey, you're going to pay this over time, and if you look at the actual guarantees, because yes, there's a portion of it that's guaranteed growth. And if you look at what those guaranteed numbers are, your return over time, let's do it in purple here. Here's your guaranteed growth. It takes often, if you just look at the guaranteed numbers, it would take 40 plus years to break even on the guarantees. It's the guarantees plus dividends that help it break even in 15 to 20 years. And those are not guaranteed, right? And they say, well, they've always paid them. Perfect. And the market has always been positive over rolling 20-year periods, right? So we can both play at that game. If we're going to say, hey, historically, this has always happened, well, then historically, the market's always done 8 to 12% over long periods of time. So let's do that instead of historically, we could get 3 to 5, right? And so the actual guarantees are actually quite garbage. You can get better guarantees in a money market fund or CDs or a bunch of other things. And again, we don't want to endure 25 years of terrible returns just to get guaranteed 1 or 2% returns later on. We can get those all at once later on. So do not buy into the guarantees. Anytime someone's guaranteeing you something, really look into what those guarantees are. Because they can say, yes, there's guaranteed growth in it. And you just kind of gloss over that. And then go look at what those actually are, though. And they're quite terrible. So no, that's a myth. Permanent life insurance is not a great addition to a portfolio due to its guaranteed returns. Okay, myth number 4, permanent life insurance is a great way to mitigate taxes. And so they love this one because, again, going back to our charts, they're saying, hey, at any point, we can, here's our non-guaranteed returns. At any point, we can pull money out of here and put it back. Pull money out of here and put it back, right? And that money comes out tax-free. So it's awesome. Like if you got, so they'll throw out some buckets, right? We've got our IRA, which goes in pre-tax and comes out taxed out here, right? We've got our Roth, which you pay the taxes up here and then it's tax-free. And then we've got our taxable accounts, which, tax in, tax out. It's not great. And so let's add a permanent life insurance bucket where, again, after tax money, it's kind of like a Roth. They'll say it's just like a Roth. You can get your money out tax-free, but you can do it even before 59.5, right? You got to wait till 59.5 here in order to get your money out tax-free. And you can do that here at any time. Okay, well, first of all, right, up to this point where 20 years later, we finally break even, any money you're getting out is just your contributions, right? And anytime you can always get contributions out tax-free. You can get contributions out of this account tax-free. You can get contributions out of your Roth IRA tax-free before 59.5, right? It's only the growth that is penalized after that point. And so that's not a benefit to this over these other accounts because anyone can do that, right? Later on, the fact that you can get it out, right? So now here, between what you've put in and what you have in growth, this part here, that's your actual gain. Hey, we now have more money available to us than we put into it. And they're saying, hey, but you can get the growth even tax-free. You can't get growth out of this account tax-free. But the way you're actually doing that is you are taking loans out against the policy. So you've got $100,000 in cash value and you take out a $30,000 loan against it. It's not really withdrawal. You're just taking a loan out for $30,000 and using the life insurance as collateral to take that loan. And so, you get your $30,000, but you pay interest to use your own money. And so, yes, you're getting it tax-free, but you're paying interest on it. The other thing you could do is you could get a loan from anywhere else. That would also be tax-free. You can get a HELOC on your house. If you took this money instead and invested it and had way more, you can take out a loan against a portion of that taxable account called securities-backed line of credit. There's a bunch of ways you can get loans off of things. And loans are always tax-free. But then, of course, to repay this, right, you have to get money from somewhere else to put that back. And that money you get from somewhere else, you probably are paying taxes on that in order to pay it back. So it's not really tax-free. You're just delaying. Anytime you take out loans and then pay them back later, you're getting tax-free money now and paying more taxes later to earn that money to pay that loan back. And so the tax benefits of life insurance are way overstayed. If you actually take a withdrawal or surrender the policy and take it all out, you will pay taxes on anything over what you put into it, same as anything else. Except that you'll pay ordinary income taxes on it instead of capital gains taxes on it. So it's actually worse tax-wise than if you had just put it in a brokerage account. So it really is true, buy term, invest the difference. It is that simple. Obviously, you have to follow up. You have to have a plan, follow a plan for a long period of time. We just talked about that last week, what to choose in investments, how to stick with a plan. So you can go back and watch that, our video from last week. Okay, myth number 5. Independent experts confirm that permanent life insurance is better. So there's a particular insurance company that's really big around where we live in Wisconsin here. We'll call them Southeastern Mutual. It's not their name, but and they love this one. Ernst & Young, which is a big CPA firm, did a study that looked at people who had permanent life insurance as part of their portfolio and compared it against just a standard 60-40 portfolio and said what was better, right? And they did some math and they found, hey, if you invest in permanent life insurance and equities, it's better than a 60-40 portfolio. Which their study wasn't that robust in the first place, but also they're comparing it to a subpar strategy. So you're taking one subpar strategy and you're saying, hey, this subpar strategy is slightly better than this other subpar strategy, which is, I can tell you a bunch of subpar strategies. I can tell you a bunch of mediocre ways to invest your money. And I can find a whole bunch of portfolios that are terrible and say, hey, these products are better than these terrible portfolios. But that's not what we want to do, right? We want to compare it to the best portfolios, the best strategies, and it just doesn't compare to any of those. So you can run the math on, right? So like 3D retirement income is the model we use to invest before and after retirement. And so if you haven't read this, you can read it. And if you do this beats owning permanent life insurance 6 days a week and twice on Sundays, because it's a better strategy. And there's other great strategies out there, right? There's half a dozen amazing strategies. I like mine the best, and so do all my clients. And all those would be better than owning permanent life insurance. And so just because someone who's independent compared permanent life insurance to a bad strategy doesn't make it a good one, right? So there we go. I think that's enough on that one. Myth number 6, successful wealthy people own life insurance, so should you. And so this is just a straight fallacy, right? They'll say, well, hey, this billionaire owns it, or these banks, they really know what they're doing with their money and they own billions of dollars in permanent life insurance or whatever else, right? And again, this one's really easy. This is a really dumb argument, okay? What billionaires do with their money should have no effect whatsoever on what you do with yours, right? The after 55 or after age 50, you can contribute like $31,000 to your 401k, right? With the catch-up contribution, 32, something like that. And most people are not coming anywhere close to that, right? You'd have to be earning $200,000 a year, and then at 15% of your income going into retirement, you would finally hit that cap. Most people don't make $200,000. Most people aren't saving 15%. So most people are coming nowhere near maxing out their 401k. Super high earners, millionaires, billionaires, right? They max out their 401k on January 1, January 30th at the latest, right? They're out of options. They use all the common, like, here's all the best things you should do: 401ks, Roth IRAs, HSAs, this strategy, that strategy. they're in the highest possible tax brackets. They're paying 37% on all marginal money they make, right? They're paying 23.8% on their capital gains, where the average person's paying nothing to 15% tops. So they're running out of options. And so if people who have exhausted all better options finally get down to C tier options and put some money in there, that doesn't mean that you should avoid all the S tier, A tier, B tier options and jump straight to C, right? Corporations who borrow other people's money and then do stuff with it, what they do with it has no bearing on what an individual does with theirs. So it's a really dumb argument for owning life insurance, and you shouldn't do it. Okay, and then lastly, infinite banking is a great strategy. So this is where people say, hey, you can be your own bank. Look at all these banks, they make millions. And instead of borrowing from them, buy a big life insurance policy, build up the cash value, and then you can borrow from that for anything you need, and then you pay yourself back instead of paying the bank back. It's the same thing. So I'm not going to take a bunch of time on this. You can borrow against anything. And so I would rather, if I was going to try to do this, right, I would rather build up, $400,000 in a brokerage account and borrow against that than own $400,000 of death benefit with $100,000 in cash value and borrow against that for the same amount of money going in. Right. And so if you want to do that, hey, I want tax-free income. I want to be able to borrow whenever I want. I want to not have to sell things and create capital gains, all these other things. Great. Invest in a brokerage account, own the best business in the world in that, just borrow against it instead of selling and withdrawing. That's all that infinite banking is. Owning an asset that grows really terribly to then borrow against it later so you can get tax-free access to money. That's what it is in a nutshell. And so you can do that if you want, just do it with a better product than permanent life insurance. So hopefully, if you are thinking about life insurance or being currently pitched life insurance that is permanent, and you've heard some of these things and you're like, oh, that does sound smart. Hopefully we've broken your belief a little bit in wanting that. And so if you are currently evaluating financial professionals, financial advisors who are pitching this to you, run the other way, get a real fiduciary. If you already own a product, don't, these are all reasons not to ever buy one. If you already own one and you're a couple months into it or a few years into it or a couple of decades into it, right, it does change the calculus on what you should do. I would say if you're 2 decades in, we may have you keep it, right? We don't automatically cancel all permanent life insurance we run into. If you're a few years into it, we probably would have you cancel it, right? But if you want to know for sure, I think there's links in the description. Feel free to book a call with me. If we do nothing else other than look at your specific whole life insurance or permanent life insurance product, be happy to just look at that with you, tell you what I think about your specific situation, and then we can never talk again if you don't want to. If you don't want to talk to me, then I think we have a link in there too. You can find real fiduciaries at fiduciaryfinancialplanningnetwork.com or fiduciaryfinancialplanning.net or whatever it is. I think there's a link in the description. And there's other fiduciaries on there, right? They are paid to do what's in your best interest. And so they are not getting huge commissions to sell these products. And so they'll give you the straight and narrow on what you should do with yours. So get that evaluated. If you're paying hundreds of dollars a month into this, it probably makes sense to double check it from someone who didn't get a vacation to Tahiti with the commission they got from selling it to you. So hopefully that is helpful in that front, right? We're always pursuing the best. How do we retire successfully, stay successfully retired? If this has been helpful, subscribe to the channel, give this video a like. We will be here throughout the week releasing shorts and other videos on other topics. And so we're always dropping new content and would love to see you around. Until next time, stay the course.